There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Good to have you with us as we round out the first week of September. Yeah, how did it go for you? Obviously it started badly, didn't it? But we're finishing strongly, so currently up close to 0.5% on the CBO 200. Tracking gains we've seen on Wall Street amid those expectations of a US rate cut. And the ASX essentially recovering after that sell down we saw earlier in the week where we took a tumble in the first 3 days but then bounced back strongly yesterday. In fact, across the course of the first week of September, looks like we're down about 1.2% across that week. Let's get to the themes, what we've seen play out today. And well, I think this really applies to what we've seen across the start of the week with that soft start. In fact, we've seen that play out with that seasonality perhaps at play. A lot of chat about how September does tend to be the weakest month of the year. Minerals in the middle, so we've had that chat apparently between Donald Trump and Anthony Albanese talking in specifically about critical minerals and their importance and perhaps some sort of partnership between Australia and the US and cut uncertainty. Well, we did get some strong GDP figures during the week, but that has lent to uncertainty over what the RBA is likely to do next with the chance of a September rate cut. They'll decide at the end of this month, looking increasingly unlikely. Let's check the sectors, those that have performed and perhaps underperformed today. Tech among the best there, although WiseTech has come off again. But Zip has done just that. It has zipped higher. Elsewhere, taking a look at Consumer Discretionary, Wesfarmers, in fact, one of the best there. And also those other retailers, including JB Hi-Fi. And, well, there's a few more there. They're actually looking more negative. Temple & Webster off some 5%, maybe. Some of those are, in fact, trading some ex-div there. Elsewhere in the mining space, just a little mix. BHP has come off, bearing in mind well, in fact, iron ore price is just a little volatile, of course, at this point. And Rio Fortescue are higher though. And also the gold miners. They actually began negatively because we did see some profit taking on gold across the course of last night, but they have bounced higher again today. Let's get across the top corporate stories. Orica flagging a strong finish to the financial year after reporting a first half loss in May. SiteMiner responding to an ASX query in relation to its 21% share price jump following its results on August 27th. So we're sitting at a speeding ticket there from the ASX. Qantas Chief Executive Vanessa Hudson will have her bonus slashed by $250,000 as a result of the airline's cyber breach. Medibank non-executive directors David Fagan and Linda Nichols will retire. And Vulcan Energy securing a key contract for its lithium project in Germany. Also, Compumetics rising on US FDA nod for its sleep testing device. Argent Minerals dipping on discounted placement there. And Peak Rare Earths hitting a 2-year high and a higher takeover offer for the company. Well, let's get to our stock of the day. As the case may be, it was actually stocks of the day. We did ask our experts, Adam Dawes from Shaw & Partners and Junbei Liu from 10Cap, in relation to that conversation had by Donald Trump and Anthony Albanese overnight in terms of critical minerals, what their pick would be in that space.
Well, I stole the best one. So Junbei wanted it, but I stole the best one. So for me, I think in the rare earth space is Lynas. You can't go wrong with it. Obviously, that chart looks beautiful. To put it out there, I hold some of this in my super fund, but it is a fantastic business that is going to continue to keep running really hot at the moment.
Okay, Iluka is the next one because it is a little bit cheaper, actually much cheaper. And Iluka, also give you the exposure to the China housing market because of mineral sands that's used to, in the pigmentation and the like. Now, China housing market has been horrendous for the last many years, and finally seems to be sort of stabilizing, still negative, but it just seems to be less negative compared to what it was. So look, when that does turn around, Iluka is will be a huge beneficiary to that. So look, I think it's you have a bit of rare earth, and at the same time, it's not super expensive, and then give you something else.
Welcome back. Well, let's get across the week that was. Joining us, Shane Oliver from AMP. Shane, welcome back. Good to see you on this Friday. So, seasonality, that's been a word I've used a lot this week because it does tend to come in play in September, which tends to be the weakest month of the year. Certainly began that way. How did you see that performance we saw in share markets?
Well, it's interesting. The US share market managed to make a record high in the last week and is still there, whereas our market came off those highs or continued to come off those highs. I would still be a little bit fearful about September. It does have this habit of being a weak month, as you say. Historically, I think it's the weakest month of the year in the US, and a similar story in Australia. And of course, it seems as if the reason the US share market did better was because they've got that weaker jobs data. And the weaker jobs data has increased the possibility, or the probability rather, that the Fed will cut interest rates this month. Whereas in Australia, our market reacted the other way. We got some stronger economic data, particularly for GDP in the middle of the week. That dragged our market down 1.8% on Wednesday. We've had a recovery of sorts in the last couple of days, but it's still left us down through the course of the week. But I think if you think about the broader monthly context, shares are a bit overbought. That's been the case for some time to come. We do have that weak seasonality. We have the risk of a US government shutdown at the end of the month because they need to pass a new budget. That's different to the debt ceiling. So the budget will come up again by the end of the month and does run the risk of another shutdown. We've got more tariff uncertainty in terms of whether the US government will get to keep the revenue. Obviously, that will take a while to resolve itself with the Supreme Court. But we've also got Donald Trump talking about announcing tariffs on chips. And I think somewhere I read about even increasing tariffs on beef and meat. So that'll probably be an ongoing issue as well. So I suspect it's probably going to be a fairly rougher month. But if I take a 6 to 12 month view, I think we will see the Fed cutting rates. I think we'll see the Reserve Bank cutting rates more, not this month, but in November. And ultimately that will help shares.
Now, Shane, you referenced the Australian economy stronger than expected in the June quarter. However, I see you ask the question, is it really as good as it looks? What's going on under the surface?
Well, this is the funny thing. If you spoke to me last week, I was away on holidays last week, but the consensus back then was that GDP growth would be 0.6%. And that was our own view. And the outcome, and then of course we got weaker data on the Monday and Tuesday, and we revised that down to 0.5% as others did, and the outcome was 0.6%. So in the great scheme of things, we're just where we were a week ago. Nothing much has changed. I guess what has got everyone excited was the strength in consumer spending in the last quarter. But even there, when you look beneath the surface, you find that it was affected by the recovery from Cyclone Alfred, boosting retail sales and spending in Queensland. We had the back-to-back Anzac and Easter weekends, so people took the period in between off and went to the shops. We had the start of Nintendo, or release rather, of Nintendo Switch. We had end of financial year sales, which are getting bigger and better in June. And so all of those things, combined with a boost to government's consumption with defence spending on military exercises, inflated, I think, consumer spending or consumption, if you call it that, overall. And I think we'll see a bit of payback this quarter. You might say, well, the household spending data that came out yesterday from the ABS, that was on the strong side again, up 0.5%. It's been up for several months in a row. But just bear in mind that last week, again, when I was away on holidays, that CPI indicator came out for the month of July, and it showed a strong rise. So it's likely that the bulk of the rise we saw in household spending in July was actually due to higher inflation, and the underlying picture was a bit weaker. So bottom line is, I reckon, yes, we are seeing a recovery in the Aussie economy. Growth is picking up. That's great. Interest rate cuts, tax cuts, those things, real wages growth, they're all helping. But you shouldn't exaggerate that strength. And I think the figures we got through this June quarter probably exaggerated a little bit on the upside.
All right. And so what you're seeing a pattern emerge as far as the RBA's moves are concerned? Cut, hold, is that the way it's panning out?
That's right. Hawkish, dovish.
Yeah,
you
right.
You go through the meetings. That's the way it's cycled, and they respond to the data as it comes out. The data in the last week was a bit stronger, so the commentary from Michelle Bullock was it Wednesday night in Perth was a little bit more hawkish. Maybe we're not going to get all those, not going to need all those rate cuts. But she did say after that, it depends. It depends particularly on the data. And so I don't think they're going to have enough evidence to do anything in September. I didn't think they would anyway, prior to the CPI and GDP data coming out. In 3 weeks' time, I don't think they'll be any the wiser. I think they'll probably want to remain gradual, and they might come up with some more hawkish commentary than we saw in the last meeting. But I reckon by the time we get to November, they will be in a position to ease again, because the September quarter inflation figures will be relatively benign in line with their own forecasts, and economic growth will still be fairly sluggish. So I think we will get a cut, but it's not going to be in September. It is going to be in November. But that's no change to our view following the last meeting anyway. I think it's going to remain a quarter by quarter move by the Reserve Bank. I guess a bigger question is, are they going to need to, how many more cuts are we going to get? I think we'll at least get 1 or 2. We have been forecasting 3, and that remains our base case, but I would concede there is a risk that the cash rate ends up bottoming out around, say, 3.1% rather than 2.85%. But we've got a long way to go before we get to that point yet.
Shane, you mentioned government spending there, certainly from Australia, having supported the economy up until now. Let's just put this in a global context, the amount that governments are spending, obviously with a focus on the debt position. And it would appear suddenly, particularly the bond market, is concerned about this again, because we've seen those bond yields, particularly in the UK and Europe, back up substantially. What are the implications?
Well, that chart I found was interesting. And the funny thing is, you saw that sharp rise through 2021, recovery from the pandemic, the inflation scare of 2022. And bond yields, by and large, are still around those levels that they got to back in 2022, whether it's the US, Europe, UK, and so on. We're not much better. But you have seen that upwards pressure lately. If you go back a month or so ago, there was more concern about US public debt with the One Big Beautiful Bill Act. That sort of faded for a little while because we've got some weaker jobs data coming out of the US. But you are seeing that upwards pressure in the UK. You referred to that. The 30-year gilt yield in the UK this week got to its highest level since 1998. So there's a lot of concern there about the Starmer government's commitment to getting the budget deficit down, given high levels of debt in the UK. There's issues in France with their budget deficit is something like 5.5% of GDP. Their level of public debt is very, very high. In fact, bond yields in France are almost getting above bond yields in Italy. Who would have thought that would happen? And then, of course, in Germany, it's not so much they've got a lot of debt in Germany. It's just that they're going to be undertaking more stimulus spending or more borrowing as part of their recently agreed package. So that's going to flow through. The question is, and also we've been seeing a back up in bond yields in Japan. The question is whether that impacts Australia much. I don't see a big impact here because our level of public debt, gross debt in Australia, is less than half what it is in the average of advanced countries and well below what it is in places like France, Italy and Japan and the US, mind you. Likewise, in Australia, our budget deficit is very modest. Assuming we do get back to budget deficit, and we probably will this year, you're talking about 1% of GDP, not 5, 6, 7% like you are in, say, France and the US. I guess the bigger issue, does it affect the US? And that is a risk that Donald Trump's doing a whole bunch of things that most economists would say are crazy. Of course, if you work for Donald Trump, you wouldn't say that, but most sensible economists are saying the things he's doing intervening in free markets, buying shares in companies, taxing businesses just because they sell chips to China. This pay-to-play model, if you invest dollars in the US, then you don't have to pay the tariffs, all those sorts of things, intervention in the free market workings of the economy, that's going to come with a cost, along with intervention in the Fed. And that could mean, given their high debt levels, that they end up paying higher bond yields as well. But so far, the US bond market seems to have been immune to this in the last few weeks anyway, but doesn't mean that it will necessarily stay that way. Now, hopefully, we don't go through a scenario like we had in the first part of last decade. We're starting about 2010, running all the way to 2015. There were scares about European debt, and along the way there was a bit of scare about US debt as well with their debt downgrade. So that could be a factor to keep an eye on. So far, I don't think it's a big enough factor. The reason share market investors should keep an eye on it is because the risk premium offered between shares and bonds currently is quite low. And if bond yields keep rising, then at some point investors say, well, maybe I'm better off in bonds than in shares.
What a strange world we live in, Shane. The US engaging in economic nationalism and the Chinese trumpeting free market economics. Who would have thought?
Who would have thought?
Great to catch up with you again for the week, Shane. Thanks for joining us on AMP.
Thank you.
All right, let's catch up with what we've seen in today's trade. The best and the worst. HMC Capital up almost 10%. Polynovo doing well again today, along with Mesoblast. And those gold miners on the list once again, led by Genesis and Volt on the negative side. Lynas, strangely enough, those rare earth miners coming under pressure despite that news that Donald Trump and Anthony Albanese had discussed the importance of those rare earths and critical minerals. Also, some of the uranium miners coming under pressure as well. Now, tonight, all focus will be on US non-farm payrolls. This will perhaps be the last bit of data that's key, determining if the Fed will in fact cut at its next meeting a little later this month. But certainly those data that has been job-wise this week has been weaker, so it looks as though it is pointing towards support for a rate cut by the Fed. Catching up with what we're seeing in Monday and the rest of the week, next week, China trade data. We also get consumer confidence for August, as well as some consumer prices and producer prices out of China, as well as producer prices out of the US. Thursday, we get the household spending insights from the CBA locally. And more companies trading ex-dividend, including one of the biggest there, CSL, which has certainly been talk of the town given how far it has fallen off the back of its results. All right, let's recap where we're finishing this week. In fact, on Friday, we're up almost 0.5% on the CBO 200, but for the week, we're off just over 1%, close to 1.2% across the course of the week to begin September. That is the COB. Thanks for watching and listening.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.